hundreds of private placements and M&A transactions. One thing that you may not know about Stan is that he was born in Brazil, and he actually has a dual citizenship. So without further ado, ladies and gentlemen, please welcome Stan Pierson.
Thank you, Priyanka. Thanks everybody for coming. I'm somewhat of a poser. I didn't get to go to IIM, so thanks for inviting me nonetheless. I don't think I would have been bright enough to get in, but anyway, I got here, so that's good. My practice is focused on representing. Can you all hear me, by the way? Yeah. Okay, I won't shout. Generally speaking, smaller companies. Some of the sample M&A deals that I noted on my bio, I think with one exception, I represented all of those companies when they were 1 or 2 or 3 founders through the exit. And I thought that with our group here today, your interest would probably lie more on the sell side in terms of those activities. Many of you are involved in building companies. The other thing I wanted to comment on before we dive into some of the slides and discussion is I am hoping, this is labeled a workshop, and I'm hoping that you will raise your hand, shout, interrupt me as you have questions so that we can try to address things that are of most interest to you. It's a broad topic. Again, starting out, my focus and what I thought would be direct this towards is more getting ready for the M&A event and some of the key things to look out for in the negotiation of those terms, the LOI, that competitive process before you lock yourself into a deal, and less so on sort of the more tedious aspects of the final agreement and things like that. So I'm happy to address anything that's of interest to you. So, John, okay.
So Stan, I have a question right off the bat.
Yes.
While he's getting set up, I hear a rumor that you're reputed to be the best M&A lawyer or M&A partner in the Bay Area. Is that correct? More importantly, if you could share with us, from a personal perspective, what it takes to be a top-notch M&A legal counsel in the Bay Area.
Sure. Thank you, Ashima. I'm flattered, though won't argue the point, but I think it's important to me and why I enjoy working with entrepreneurs, whether it's me or any other good advisor, is I think we have to listen. Most of us, as a lawyer, we love to negotiate. I like to get at the table. It's a lot of fun, M&A. But I think, for the most part, I serve my clients better leading up and listening. Once you get into the process where you're at a table where they have a term sheet and the buyer turns it over to their financial advisor, their legal, their HR, it gets very difficult to slog through and get the best terms for your client. So I actually think it's more effective to counsel our entrepreneurs leading up to that process, to advise them about the bidding climate when you get to a competitive situation, how you can maximize that, to get key terms in a LOI or term sheet before you get to an exclusivity. Those are all critical to me to get the best outcome, and then to spend some time saying, okay, here's some options that you're going to be presented with the corp dev or biz champion on the other side. Think about this. Think about your key employees and your retention packages before you get in a place where the train's fast moving, the board's excited, they want to sell the company, and then your leverage has dropped tremendously. So I'd say that, and most important, is working with quality people, and I've been blessed to work with some great entrepreneurs over the years that are really totally the people who created the value, and they were people of high work ethic, high integrity, and when you have that and driven to succeed with their businesses, it's really a pleasure working with them. So before we get started, obviously, M&A trends are up and down. They're a critical part of what we do. The reason I thought we'd focus on it today is it is obviously the most common exit. We all talk about IPOs. We have the occasional IPO, but the vast majority of successful exits, and even the ones that aren't so successful, which is still okay, it's better than not, obviously our M&A, so we'll focus on that. In the last quarter, there's obviously been a lot of activity. I was reading recently, I think at the end of the slides, I have a slide on dollar value, but it's been the highest dollar value in Q1 of 2014 since 2007 overall. I think tech-wise, it's maybe the highest ever with deals like NetApp and Oculus and non-tech deals like Safeway's acquisition by the PE firm and so forth. So there continues to be a lot of activity, and that drives obviously a lot of the early funding in that ecosystem. So it's critical to our startups getting funded as well. So let's dive into to the topic, and again, please feel free to stop me and raise your hands with questions or comments. See if I can. Okay, we're gonna. This is just an overview of what we're going to talk about in terms of why companies look at M&A as a liquidity event, and then some of the dynamics during that. Obviously, there are a number of reasons for an acquisition. The buyers have operational, financial synergies. They may look at a given product. There's IP they may need to acquire, strategic reasons. One thing that is often goes overlooked in the press, but those of us in the industry know, is the key employees in the team is extremely critical in these situations. I find it interesting that lately, some of you have heard recent year or two, people have labeled, oh, we're experts if we do acqui-hires, or we do these talent acquisitions. Well, that's just a new label on something that's been going on in the Valley for a long time. I was sort of using the first time I heard that because I remember in 1999, 2000, selling companies that were 6 or 9 or 12 months old for $150 million in stock and this kind of thing, because the buyers had so much value in their paper, in their stock, and they couldn't acquire the kind of talent they wanted by giving them options or anything else. So they would buy their companies, a team of sometimes only 6 or 8 strong engineers, and give them a lot of money in stock, but they would revest it. Even if the company had vested stock, they would revest it over a period of time to basically cause them to stay as a retention mechanism. But that continues to be a lot of what we see in the Valley for smaller companies when they're acquired, is to make sure that there are key retention mechanisms for the best employees. Obviously, there are other reasons we won't go along on the buyer side, acquiring a particular product line. From the sell side, obviously the most traditional reason given is essentially liquidity for shareholders. But there are many other reasons. Often a company is very strong in the product, but it can't scale across multiple markets, or it's very expensive to have a sales force, or depending on the channel, when they only have 1 or 2 product lines in their bag to sell, and they can create much greater efficiencies across that. There's also compliance issues as companies get larger. That I represent, and they look at, well, we could go public. I'm thinking of a couple in particular the last couple of years, but it's very, very hard to predict their revenues. They're very lumpy. They have a great quarter, they have a low quarter. And it was just the nature of their business, and looking at the opportunity to build that out over a longer period of risk versus getting acquired was a significant factor. Another, quite frankly, is even if you go public, the liquidity is locked up at least for 6 months, and then after that you've got issues with selling in the market in Section 16 and short swing and what that says. So while the investors may be able to get out by distributing their funds, it's a lot harder for some of the officers to get out except over a longer period of time. And the other, sometimes you can actually obtain an agreement. What's interesting, I haven't done this well, but interesting, some of you have seen when companies would actually file an S1 as a way to say, come get me now, or it's going to be a lot more expensive. That's not something you're really supposed to do as a lawyer. You're filing to register, but you do see that from time to time. And you all probably have seen examples of that where a company did talk about going public, and that was a catalyst for really having that entity be acquired by other larger buyers. So let's talk about the initial process itself. Before we dive into it, as in your company, once you get to this stage, there's something. Oh, I'm sorry. Please go ahead.
I just wanted to check. Could we get a copy of this presentation afterwards, or do we take notes?
Sure, I'm happy to give it to you. If you let me proof it for typos first, that's fine. I'm happy to send it. Sure. So one thing I would like to say is, as we go into this, there's a lot you can do during the process. There's a lot you can do beforehand to get ready. And I think I'd be remiss if I didn't just touch on a couple of key things. Once you get in the diligence process and you have a buyer, if you're scrambling to fix a lot of things, first, you don't have a lot of time. Second, you can raise a red flag if you appear disorganized and cluttered. And even though any one given fixing of a document of diligence or going back might not appear to be material by itself. There can be an impression overall of the buyer that, wow, if this company is this scattered here, maybe their IP isn't as rock solid as I thought, or maybe the person's not quite as organized as on the ball, and what does that mean for financial controls and otherwise. So I don't want to overstate that, but you're doing so much at the time that you're looking at considering bids that you want to do well along the way to get up there to have good solid basic things that aren't exciting to talk about, but for example, you all know every employee needs to sign an eventual assignment agreement. You know, you're going through the diligence process, you find out that one or two people have not, they've left the company. You know, the buyer will do an analysis and check and look at your code and check every employer or consultant who was there, and if there's one or two missing, that can be an issue. And as you can imagine, it's hard to go back to somebody and say, oh, well, you signed this, and they'll say why, or suddenly if they realize it's either you're getting financed or acquired or something, they have some leverage, and it can be quite difficult. It should go without saying, but those are things you can often take care of fairly easily before there's a sizable event. Another thing that's not directly related to M&A, but I'll say as part of your negotiating and financings, is participating versus non-participating preferred stock. When you're negotiating to take investment, I don't know, quick hand show and also to wake up, any people roughly know, do people know what that is? Let's just give a quick, so when you sell preferred stock, you have two scenarios. Either the investors get their money back on the downside. Let's say you raise $10 million in a sale of less than $10 million. They'll get their money back before the common gets anything. That is before the founders. You all typically will get anything. And the most founder-friendly form is a non-participating preferred, where you get either your money back or you convert to common for the upside. In a fully participating preferred, all the money goes back first, and then the common starts to participate. And there's also the upside for the preferred. For example, in a deal I did last year, we managed to keep it non-participating over a number of years. And the company had raised about $100 million. And the deal size was about $380. So in that instance, the employees, everybody got common equivalents, and the employees shared in about $100 million that otherwise would have just come back to the preferred. So it's a very notable term, and you can't change that one after the fact. Another thing to realize is that sometimes when you're negotiating acceleration events with founders, you don't always, those can be revisited in the deal. But the takeaway is, say you set up a company first in a fairly clean way, you'll really be ahead of the game. Going through the early M&A process, sorry, I'm just trying to run some slides. Let me just go through. So, in the first step, we're going to be looking at what's the nature of the deal. And without going into a lot of detail here, most of the acquisitions are done through a merger context. Some of you work overseas, they don't have this in some countries. I'm doing a deal with the UK right now that doesn't have a merger statute. But in general, the concept is the buyer sets up a subsidiary, the subsidiary merges with your company, the target, and as a result of that, the buyer owns the company as a wholly owned subsidiary. The advantage to you is, in that structure, is they take everything lock, stock, and barrel. They take the liabilities with the assets. And the shareholders of the target, you don't have to get every single investor shareholder to sign. You just need a majority, and under the statutes, the only right of somebody who didn't approve the deal is to pursue what we call dissenter's rights or appraisal rights, depending on the state. And that means they can go to the courts and try to show that they should have gotten more value, which is difficult to do in an arm's length acquisition. But that's the only right. If you do a share purchase, you have to get every single shareholder to sign. If you do an asset deal, then the buyer buys the assets. That comes in at the corporate level. That's basically, you have an issue with, it's treated as if the corporation sold something. So that, at the first level, is a revenue to the company. Unless you have NOL to offset it, that's a tax. That's not tax variable. And then the distribution to the stockholders is a second taxable event. So where you tend to see asset deals is when things haven't gone well. Let's say the investors are getting 20 cents on the dollar and selling for a little bit of money, and the buyer is concerned about liabilities, and so they only want to take the assets. But most of the deals you'll read about, and certainly upside deals, it'll be a reverse merger structure. Without getting into more detail there, the advantage of the reverse structure is that the target company, usually your company, remains a legal entity, so you don't have to assign every contract and move everything over to a new entity unless there's a provision in a contract that says change of control requires consent. I touched on some of these reasons, consents, notices, and the statutes for merger. This is a chart. So who are the key players in the deal? Obviously, the business professionals, you've got typically the corp dev or biz dev people on the buyer side. Typically, my clients don't necessarily have a quote corp dev person. They might have a biz dev person that's more on the product side. So it's usually the CEO, the CFO, and the board on the target side. But on the buyer side, there's often specialists. Typically, in an acquisition, there's a champion on the other side. But pretty much always there is. But it really makes a difference if that person remains engaged throughout the process. Because it can be bogged down, they let it sort of, oh, HR has it, or oh, my attorneys have it, or oh, my finance is reviewing something. You need somebody on the buyer side to really help manage the people, and a good corp dev guy on the buyer side, even if they're negotiating hard, will really help the process as an main point of contact. But don't lose sight of whoever your champion is on the other side in that dynamic, because you'll often need to, you can't use your bullets too often, but you'll need to, from time to time, call them up and express excitement and enthusiasm while meeting to say you need to give a kick in the pants to so-and-so because, you know, the process is being bogged down. Obviously, you have other advisors, usually lawyers, accountants, very instrumental on both sides in terms of looking at purchase accounting or looking at how things will be treated afterwards in the hit, and whether it's accretive. Those are especially important to the buyer typically. You know, bankers are an interesting, it can create a lot of value. It's interesting because I've done some very large deals where the founders didn't want or didn't use bankers, and I've done many where they were extremely helpful. So I think for the most part, and certainly they would tell you this, they're extremely helpful. But I've also been in deals where after the first negotiation, the buyer said, you know what, let's leave the bankers home at the next session, and the UCO, bring Stan, bring our lawyer, and let's just get a small group and not have as much. But that good cop, bad cop can sometimes be really helpful. Not to mention, before you get to that phase of negotiating term sheets or documents, making sure you really scour the market and do a check. That said, some of the stronger deals I've done, and it sounds trite, but it's true, you know, when you hear companies are bought, not sold. If you get to the stage where you're trying to sell and you hire a banker and you're going out and shopping that way, it's usually not a point where you're going to get the best exit. The best exits tend to happen where you have a business partner that develops into something, they show interest, they already know you, so they have a high comfort level. It may or may not be that person that buys you, but it triggers a process, and then you're, well, you know, we're excited, we want to stand alone, but we have to react to this because it's so interesting, so favorable, and maybe call a couple other people who then want to jump in the fray and we have a bidding contest. The bankers can be extremely helpful with that. And then going through outside or inside counsel, there's a host of things that they're also involved in terms of experts on these deals. So let's talk about the process leading up to this. So you've got a potential acquisition, you've got interest from the other side, and you're heading towards a term sheet or LOI, and what does that mean? And again, please jump in if you have questions or if you've been through some of this. So one of the, this is really a key dynamic because, and it's not unlike the term sheet for financing, but once you sign such a document, it'll invariably have a no-shop or exclusivity clause, and it'll say for a period of time, usually in an M&A not less than 45 to 60 days, sometimes even longer, you're locked in with this buyer, and you have to deal exclusively with us. And so, of course, what that means is you have to turn on anyone else. They'll usually have other language there that says, and if anybody calls you or submits an indication of interest or other offer, you have to tell us who they are, et cetera, and we usually try to carve that out and say, no, we violate confidentiality, we can't do that. But still, as a practical matter, you're locked in for a period of time, and you have to turn off other people. They may go away, they may or may not come back. So how can you maximize that? There's a tendency to want to hurry up and kind of have the LOI done to get to the next step. And some of these things aren't even worth a piece of paper I've written on. They'll be, hi, we're very pleased to talk to you. We can envision a deal of up to $100 million, say, subject to diligence, subject to various things, and we'll work it out. So please sign this no-shop and let's go get to work. We'll say, well, what does that mean? It doesn't mean much. They're not locked in. And I should point out, none of these LOIs lock in the buyer to do a deal. The only thing that's binding is confidentiality. We'll get to that in a minute, and the exclusivity. But it does set the groundwork for what the business deal will be. So you can resist the temptation. There's two important reasons to do that, to sign that up too quickly. One is you really want to drill down on some important terms. For example, you'd like to understand retention for key employees. You don't want to sign in and have them say, oh, we didn't know you were accelerating on the merger. You have to revest all your shares, or you have to vest half of them, or something like that. You want to understand if there are key business conditions that you can meet that you may not have talked about that could affect your ability to close a deal timely or at all, and many other things, including on the legal side. It's not always as obvious, but you want to limit your exposure. I like to say sometimes you get these deals and say, oh, and of course, if you have any mistake in your representations, your covenants, we can come back and recoup our losses. And we have to say, no, what's the escrow size? What's the exposure? Is it 15%? And limited at that, our clients want to keep the proceeds, not rent them. We need to be clear about what this means. So if you don't do that, you still have the discussion, but it's very difficult, more difficult after the term sheet is signed and at no shop because your leverage drops a lot. A second reason to have those discussions is while you're having them, you can scurry around with your other potential parties and say, I need it this week, I need this, or the next 48 hours, I need this, have other meetings. So you're negotiating in good faith with the lead, but you're also doing kind of a last check. And that dynamic is important both with respect to saying you can get a better deal, but also having leverage over the buyer. So we touched on this a little bit in terms of the letter being non-binding. Just the takeaway is that it's extremely important to kind of get some of the key terms baked because it's a lot harder to do it after a shop period. Confidentiality agreements. The one thing you'll know what those are and the importance of that. And of course, you worry about things like the buyer just wanting a free look and not really being that serious. That's one dynamic. And as a practical matter, you can't be assured of that. But one thing you often do is, you go through gradations of disclosure. And so maybe there are some things that are really key jewels about the company that you wait until the very end. And they're necessary to sign a definitively binding agreement, but you wait until deep into the diligence process to disclose. One other thing I'd like to point out in this process with my smaller company clients is the non-solicitation of employees. We talked earlier about talent acquisitions and things. Buyer, when they come in and see your business, they also see key people, what they're doing. So I like to ask, unlike standard confidentiality, and this isn't as obvious to some people, for a no solicitation, no hire. Because you don't want them to, oh, that was interesting, sorry, it didn't work out, can agree on terms, and the next week you find out that 3 of your top engineers are going over. So that's something to look at in an NDA. Yes, Arjun.
I'm Arjun Batra, I'm from IIM Calcutta, 1967 back. My question is, with all the things you hear about people stealing other intellectual property, during this buying negotiation, do you disclose all the non-patented IP as well to the buyer from the seller side? And how deep can they look at it, and what's your risk as a seller?
Yes, no, yes. No, that's a great question, and I was sort of touching on it a little bit, but not in detail, because there's always some risk. So it's what I would say a step process. First of all, there's trade secrets and things that you don't disclose because by nature of disclosing them, you lose the rights. Sometimes with patents, or an example would be concerns about infringement, where if you share it with a party, you lose your attorney-client privilege, and then another party to depose to find out or use that against you in litigation. For the most part, there are several different things we do. Just to give you a few examples beyond the broad statement I made. One is sometimes there'll be a provision of a contract, and we'll say, okay, your lawyer, you're not your inside lawyer, but your outside lawyer can come over to our office. We'll show you an agreement in our conference room, certain provisions, to be satisfied that we're not really breaching the confidentiality. Maybe we are a little bit, but to satisfy them with respect to a particular term. Or as I said earlier, we'll wait or they'll talk to people about the technology, what it does, but not quite what it is, if that makes sense. You know, kind of dancing around it a little bit and addressing it, but not really getting into how you replicate it. And sometimes there'll be experts or consultants that are third parties that are under NDA that aren't the buyer that they'll look to. But it's really a dance at the end of the day. Question?
Dylan Brown from the 78. I've been through this process and I have more comment than a question. Really, this term sheet, you're giving it away to the buyer. There's no obligation on them, as you said, to do anything. So the approach we found was best was to limit that term in terms of the period to 30 days. And the way we did that was getting a whole data room up front and said, here is every contract you've ever signed, here's every agreement, whatever. Look through it and tell us what you need. And we'll give it, we'll put it there. But we won't sign the agreement until you've got everything you need. So now, in 30 days, you should be able to close it. And that way, we limited a lockdown, if you will, and lock other people. That's just one process that worked for us.
Yeah. No, that's a great, you're well advised, and that's a great thing to do. An example of that, often we try to cap indemnities, for example. You know, often you're arguing about 10 to 20% range, and you often end up something like a 15% escrow in 12 or 18 months. And they'll say, oh, we can't possibly do that until we're deeper in diligence. You say, we have a data room, you're under an NDA, go have at it. And often, you know, that'll work to a point. Often they'll come back, well, we can't commit even more resources and go to the very top and go to our board and, unless you sign the LOI. So there's often some back and forth, but that's definitely the first choice. If you did that and just shorten it. I've been in situations where we knew another buyer was lurking or they seemed to be stalled. So if you had a 30 or 45-day period, as short as you can get, as you mentioned. You know, I've had a couple situations where we just let it run and went with the other buyer, or we let it run and then the original buyer got nervous. And well, of course you have to extend. We're working in good faith. No, we don't. We have enough time. You know, we'll keep talking, but we're not going to sign another no-shot. Clients get a lot of pressure, and sometimes they cave to it and say no. They say they'll walk, and there's a lot of. And just a quick anecdote on that. Once I had that situation with the data room, as you mentioned, and they said, oh, we've got this issue, we think, you know, we're going to have to change the escrow, it's bigger, it's a problem, I don't know that we continue. And we said, okay, and we shut down the data room. This was, I think, on a Thursday night. It just sent them scrambling. By Friday morning, they came back, and it was a complete, you know, about face, and, oh, what do you mean? She says, we're going to proceed, so that's fine, we'll go our separate way. And because we took a hard stand, they came back, oh, it's okay, no, you have to open up right away, we're not going to finish the deal. Well, you said you were going to do the deal, you know, so it'll be a lot of gamesmanship, and you have to at times sort of draw a line and be willing to indicate that that's not your only option. Even if your option is a standalone company, that's probably the most important in the process, because there may or may not be another buyer, but if you're confident in your standalone basis, you can sell on your terms more likely when you're ready. Other questions? In our last few minutes, I'll jump, due diligence. I won't spend a lot of time given our remaining minutes here, but it's not sexy, it's not exciting, it's so important. It's just hard to overstate, as John was just mentioning. The buyer will be excited at one level initially, get you locked in, and then there's this period of time where it can just be a grueling period of the buyer turning over every stone, looking at every contract. I had a company last year that had been around for quite a few years.